Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com. Welcome back to the show, Steve.
Thanks for having me on.
Steve, how are September home sales and prices trending?
Well, we saw a big bounce in sales, just really ultimately low base effect. So sales are up 46% year over year. Obviously makes for a really compelling headline. But if you look at it, sales are still technically below the 10-year average for September. So I would say that, the consensus is that no doubt the market has picked up, particularly over the last 3 months. I mean, we have condo sales basically right along 10-year averages. So, but I'd say in general, the market is still, I don't know, I think that's cautious optimism. I think that, you've seen a pickup in activity, prices, of course, just the way that they're recorded, right? So I think people have to understand how the metrics are recorded. Is the MLS benchmark showed prices were down again on a year-over-year basis across all segments. That's really, again, a lagging indicator, just, the way the MLS benchmark is recorded. So what we're starting to see, if you look at more leading indicators like, average price per square foot, sort of more real-time data, is you start to see basically prices essentially flatlining. And again, that's not to say that, hey, this correction is over and it's smooth sailing from here and, prices are going to start going up in 2020. I mean, that could certainly be the case, but, I don't really put a strong weighting on that. I think that, there's certainly still some headwinds, in the housing market and, but I think right now what we have is, we have a market economy with mortgage rates still at 2.7%. And, still today in BC anyway, still everyone's got a job. So I think that's kind of put a floor into the housing market, as I've talked about numerous times over the past few months. But again, the headwinds are still out there in terms of record number of new construction, coming to completion over the next couple of years. A lot of condo supply coming. Obviously again, we're sort of, I would argue, late cycle. Do we get some slowness and softness in the labor market that then puts further downwards pressure on the housing market? Certainly possible. If you look at the latest September numbers in the labor force in BC, Canada recorded another 57,000 jobs, but it's now the fourth consecutive month that the BC labor market has been contracting. So. Again, is that a trend here? I guess we'll wait and see, how the next few months play out, but certainly, lots going on in the housing market. I don't think the story is over just yet.
Now, even though, have prices stabilized? Are you seeing a comparable house selling for the same price it did a year ago, or are house prices coming down, or does it depend on neighborhood? Yeah,
so honestly, it just really ranges all over the place. And it's funny, I look at, I have all my data system set up. So you go through that, but you also go feet on the ground. You talk to a lot of other realtors, and it's really just completely all over the place. So you still have, really a lot of weakness and softness at the higher end of the market, obviously, because I think it's a finite number of buyers there, right? It's a limited supply of buyers, and so that high-end luxury market is still very, very soft, very weak. But then you have sort of the more local market, which is sort of, your single-family house with a basement suite downstairs that can help subsidize somebody's mortgage at around $1.5 million, and that's getting traction. Those are selling relatively quickly. You're seeing multiple offers in some condos, because that's ultimately, again, it's sort of come back to this local market. I think that the foreign speculative bid, particularly out of China, is dissipated. I really don't see them active today at all. The investors are still skeptical of the market and where it goes from here. And obviously speculators are completely pulling out of the market. So like, you're not really seeing, home builders, speculative home builders buying up plots of land to, smack down a house, build a brand new home, and then try to sell it off like they were in 2015, 2016, 2017. What you're seeing is basically people that are buying these houses and condos are all people that are looking for primary residences. They're all end users. And, what can they afford, even with mortgage rates at, getting close to record lows again at 2.7%? They can only afford these narrow price bands. And so I think that's where we're seeing.
Steve, are we seeing improvement in quality for what people are buying for, say, the same price they were paying last year?
I think that's kind of a hard thing to measure, right? I think it's a little bit subjective. I think that certainly your money's going further. You have prices are down, mortgage rates are down. So I think that people are able to buy, definitely a better house than they were, a year or even 2 years ago, substantially. So I would argue that your money is definitely going further.
We'll have more with Steve Saretsky right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Steve Saretsky. Steve, are the central banks printing more money, and are the banks passing it on to consumers?
Well, they're not. I mean, the Fed is talking about basically engaging in some form of QE again. I mean, they don't want to call it QE, so you could argue that's basically money printing. But there's been. I'm not the repo expert here, so I'm not going to really comment on that. But we know there's been some instability in that market, hence why the Federal Reserve has had to step in. The Bank of Canada is pretty much sitting pat. Haven't really done a whole lot, but I think that's probably the most likely scenario. But, even then, if, you start lowering interest rates and doing a whole bunch of QE, at the end of the day, you're basically just essentially building up excess reserves. So at the end of the day, the commercial banks have to actually lend out that money. They have to start issuing new debt and new loans. And so, in order for low rates, it can be confusing because I think there's a bit of a misconception out there is at the end of the day is, you can lower rates and do QE, but in order for that to be similar to, for say, housing markets, there has to be a transmission mechanism for that money to actually get in to the housing market and then to obviously inflate housing prices. And so, that ultimately comes down through commercial bank lending, ultimately increasing the number of loans in the real estate market, right? So issuing new mortgage debt, that is how you get a rise in home prices. Mortgage debt growth in Canada, unfortunately, we can't break it out provincially or even by city. But what we are seeing is the rate of mortgage credit has it was growing last year at multi-decade lows, near 20-year lows, and recently it has been picking up steam consistently over the past 3 or 4 or 5 months. So we are seeing mortgage credit growth start to pick up, but again, it's coming off an extremely low base. And I would argue that, just speaking with a lot of people in the mortgage space and in the banking world, is that banks are concentrating more of their loans further out east into eastern Canada, and so that's why you're ultimately seeing a lot of strength in those markets. So they're sort of taking their loan book, shifting a lot of it away from Vancouver and Alberta, where the markets are quite soft, and then you shift that over into Ontario, where the market's still booming, Montreal, Ottawa, a lot of those eastern provinces. And that's basically what we're seeing.
So what kind of an effect does increasing unemployment in Alberta and BC have on home prices?
Well, I mean, it's huge. Unemployment is I think that, particularly at these prices, right? So I think the two largest things that are going to move a housing market are ultimately is the cost of borrowing and the availability of the credit. Because again, the cost of borrowing, you can have mortgage rates at 2.5%, but if the banks don't want to lend you the money, it's irrelevant. So, it's the cost and the availability of credit, and then second is the employment market because, again, mortgages could be cheap and banks could be happy to lend, but if you don't have a job, it's irrelevant because you won't be able to service that debt, and the banks probably will look at you and say, well, you're not a very creditworthy borrower because you don't have a job, or, you're only working part-time, or your spouse just got laid off. So, and particularly when we look at the indebtedness in Canada, particularly in like Vancouver and Toronto, is at the end of the day, you have local incomes where they're at. I think everybody's well aware of where they are, and you have these very high, indebtedness and mortgage payments. And so those are serviceable as long as, mom and dad are both working full time. But obviously if any one of them, gets laid off or goes from full time to say part time, all of a sudden those debt servicing costs can be insurmountable. And so I think that's when you start to see, delinquencies go up. So I don't necessarily think that you need higher interest rates to get that. I think it just comes down to some instability in the labor market. And it's interesting if you look at it too, is the debt servicing ratio in Canada, actually in the second quarter of 2019, actually just hit an all-time high. So, that goes, despite interest rates being basically at rock bottom lows, the debt servicing ratio for Canadian households actually just hit an all-time high. So I think that should kind of tell you that, the rates have very little room to go lower, and you have households that really, it's going to be hard for them to take on a whole lot more debt. It's hard for them to continuously expand that balance sheet much further, just because the debt servicing payments are becoming, I think, crippling.
Is it a case in for a lot of people that they're mortgage rich but cash poor? They make their mortgage payments, but they don't have much after that? Yeah,
that's pretty much. I don't think that's a secret. I think that everybody, there's a lot of wealth built up and equity in housing and real estate, and that is ultimately a form of forced savings for the majority of households in Canada. And that's viewed as sort of your retirement plan, so to speak. But and at the end of the day is the rising home prices has fueled the wealth effect. So people are able to, they're feeling more confident about their well-being, and so they go out and they borrow and spend money, and also simultaneously, they'll borrow equity off the rising home values, through home equity lines of credit, refinancing their home, extracting that cash out, and then, going out and enjoying and spending that money. So, a lot of the Canadian economy is propelled to the Canadian consumer, which is ultimately propelled, through higher home prices.
We'll have more with Steve Saretsky right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, what are your thoughts on financial advisors who suggest people take a HELOC, a home equity line of credit, against their paid-off home to invest in the stock market and or in other real estate products?
I think everyone's situation is different. I'm not going to give financial advice. I think that it can certainly be done. And I would almost encourage it to some extent if you know what you're doing. If you can borrow you can borrow money at 3.5% and you can get 8 or 9% all day long, then I think it makes perfect sense. But obviously, I think that it comes down to the individual. What are you doing? What's your risk appetite? where are we in the cycle? We're obviously late cycle, so is it the best time to be leveraging up and taking on added exposure? I would argue probably not, but I think that's up to the individual.
Mm-hmm. Have people been using their home equity like ATMs to buy cars or go on vacation, not investing it?
Yeah, I think that's the problem, right? I think that, hey, if you can tap your home equity, if central banks, want to keep rates suppressed and banks are happy to lend you money at, again, a home equity line of credit at 3.5%, and you can go and invest that and get a 8 or 9% return all day long, then obviously I think it makes perfect sense. But, if you're going to go start tapping that money and then, go on these lavish vacations and, buy these cars that you can't really afford, but you're just kind of betting on continued home price appreciation, then I think you're kind of setting yourself up for a bit of a disaster. But again, I think that everybody at the end of the day makes their own decisions, and I think that we've kind of bred a bit of complacency in households just on the assumption that home prices will continue to rise and that rates should, stay low forever. And I think that people have certainly taken advantage of that.
Is Vancouver the kind of market with so many people moving here every year that even if you have a downturn like we've had the last couple of years, things are bound to get better?
Well, I think Vancouver is always going to be a desirable city, and I think that it's always going to maintain, relatively strong value in their housing market. It's never going to get down to these quote-unquote affordable levels where it should reflect some sort of income. I think it's far past that as a global city, but I think at the end of the day, if you look at Vancouver's population growth, it's been growing at about 1.8% for the last 20 years. So the population growth hasn't been anything to write home about at all. The population growth that has been strong and rampant is actually in Ontario. But actually, at the end of the day, population growth is also cyclical. So, immigrants come here to work and to get jobs because the economy is doing well and there's jobs to be had. But generally speaking, as these people that come here, non-permanent residents looking for work, they're the first people to get laid off at the moment that the labor market starts to soften. So that's the case basically, at the end of the day is, if you look at Spain and Ireland, their population's growth prior to their housing bust was growing at about 5% annually. So they had massive population growth, but despite that, their housing market still falls. And if you actually look at it, their population growth went from, they had net migration to net outflows after their economy went into the tank. So, again, obviously if you're an immigrant or you're someone looking to relocate, you're not going to relocate to Vancouver or Toronto if there's no jobs. So it really, again, this is where we had this conversation earlier, it really comes down to the labor market. As long as the labor market is strong, I think rates are going to continue to be low as where they are. That's going to provide stimulus or a boost to home values and immigration. But if you get some slack or weakness in the labor market, I think that has knock-on effects not only for the housing market, but I think it also has knock-on effects for migration flows.
We've had so many politicians talk about so-called affordability during the election campaign, but have any of them put forward any kind of plans that would have a real effect and help out people?
I don't know. Truthfully, I didn't really see much. I think that the whole sort of debates were pretty unfortunate. I think it's, it's just disappointing. I think that, obviously they'll promise you things and then not much gets done. In terms of housing, the only thing that I've sort of seen that the governments are proposing from all angles, regardless of where your political leaning is they're looking for more handouts, more buyer demand, more stimulus to enter the housing market. So, the way that you get more affordability is not by, giving out more handouts and free money to people to then go and bid up home prices. So, we saw conversations about providing first-time home buyers, more an advantage and giving them basically, government incentive to go and buy new housing, 30-year amortizations from the conservative government. I think the NDP and is, talking about removing the stress test, I don't think any of this is going to accomplish more affordable housing. I think that government should ultimately be working with the development community, I think, to add in more supply. And I think that, you're not going to get there by easing credit availability.
Steve, thank you so much for chatting with us.
Always a pleasure. Thanks for having me on.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com. If you have any questions for Steve or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.